I'm John Marino, Senior Editor covering private equity with The Deal, and I'm joined today by Sumeet Shah, Director of Client Relationships with Just Digital. It's a new startup he's been working on. We've been kind of missing you from the Twitter sphere ever since you've kind of dumped behind the PE Feeds moniker, now that you've officially left it all behind. I know that you're going to still be, I guess, providing us some updates. I noticed that they've been a little bit fewer and further between, but that's okay. We're finally, kind of out of the presidential campaign and to the point, I guess, where private equity is starting to soften up a little bit and maybe be a little bit less concerned about their public image. But during the campaign, it was a pretty bruising campaign for PE. So from a public relations perspective, the woods have healed pretty nicely over the last 9 months, right?
I would definitely say it's definitely healed. And again, thank you for having me here. I know the Twitter handle for behind PE Feeds has been a little bit sparse in terms of the private equity tweets, but I promise you, once I get a little more settled in over at Gist, it's going to be back to normal, almost to square one. At least I'm trying for today. But going back to the original question, it definitely has healed in terms of those wounds, and it definitely seems less of a spotlight in terms of the general public on private equity. But I still think that that doesn't mean that the PE industry should hold back in terms of really explaining about its public image. What you've definitely been seeing more so is that you've been seeing the lobbying firm, the Private Equity Growth Capital Council, the PEGCC, as well as the advocacy group ACG, the Association for Corporate Growth, push more of an education front to members of Congress. I mean, you've definitely seen infographics, you've seen state-by-state charts that the PEGCC and ACG have been doing, I think in collaboration with PitchBook, to really just get the data in terms of privately backed companies, returns on pensions, and the breakdown in terms of Democratic versus Republican-focused states and districts as well. It's going to be a very important point to hammer that home, especially because a lot of the states and a lot of the districts that have a significant amount of private backed companies, as well as the returns that are bringing back for those pensions, are Democratic. While we looked at the campaign season and we looked at the election season, where it was literally just a giant tornado for Mitt Romney and the private equity industry on both sides of party lines, it's definitely something to see that you have both groups focusing on Congress right now. But I think the story that still needs to be told has in some way really pulling back the curtain on the industry and showing what it's been doing with the companies that we've been influenced on a daily basis. I mean, everything from J. Crew to Skullcandy. There are stories that really need to be told, and it's really up to those PE firms that can really tell them.
And it's interesting that you obviously point out the Democratic states with big pension returns to count on from private equity, CalSTRS and CalPERS being two of them, both just reporting double-digit gains. That's largely PE. That's not VC money, because obviously they've announced that they're going to be scaling back on their interest in venture capital. Moving along a little bit, one of the more popular tools, at least in more recent years for PE, has been the leverage recap. And I felt like during the election, if we could have boiled this down to a soundbite, it probably would have been used against Mitt Romney. But there was really no way to turn a recap into a one-sentence kind of demonization of the industry. Again, now that we're kind of out of the presidential election cycle, is the recap kind of okay again?
I don't think it's ever been okay, because it's still a very difficult, risky tool. I mean, if a dividend recap was used correctly, it's meant for the process that the private equity firm is holding the company for a long term while it's trying to give some short-term returns back to its investors, basically pleasing the investors at that process while making sure it's continuing the sustained growth and expansion for the company that it's holding right now. It's always going to be a risky tool. I would never ever say it's in the clear. It should never be in the clear, because if there is a failure, it's a failure that should be addressed, and not so much in terms of it turning into a soundbite, but more in terms of a what have we learned kind of thing. I mean, I've definitely seen private equity firms that have misused the dividend recap, and to the fact that they may have used it so many times over 1 year, 2 years worth, that they actually drove the company into the ground. It's a very worrisome situation that you see firms that have done that. But I guess if there is a bright side to it, those private equity firms are then internally policed, where other PE firms that would consider co-investments would think twice, as well as obviously the investors themselves, the LPs, would even think twice about putting capital again for their next fund.
Right. And obviously the debt financing scene has gotten a lot more friendly for PE. I feel like if so many folks are running out and taking out debt on so many of these companies that they LBO'd years and years before, there might be a little bit of an outcry over it. But obviously a lot of this cash is also going back now to kind of take out that debt coming up in the 2014, say, to 17 range, and kicking the can down the road and also taking a little bit off the table for yourself maybe isn't looked down upon the same way that it was like 2009. Anyhow, PE is moving forward, the industry is moving forward, and the Jobs Act is really helping them. It's helping them get companies now into the pipeline where they aren't, I guess, exposed to, kind of a Groupon level embarrassment maybe if things don't go the way that they planned. But another important part of the Jobs Act that was just approved by the SEC is a change to general solicitation. It's huge for PE. It means that we're going to be seeing, possibly KKR and Henry Kravis's big smiling mug on the billboard on the Upper West Side Highway. Maybe not. But it also seems like this is another big opportunity for private equity to really kind of pump up their public image and also, again, kind of point to those returns, right?
Yeah. It's funny actually you mentioned Henry Kravis because I know he has a wing over at the Metropolitan Museum. Can you imagine actually if you had his big mug in his own wing within the museum? I kind of hope that actually never happens. But anyway, it's definitely a potential boon for private equity, but I think it's also a potential boon for the SEC. What is really important that is a great opportunity that the SEC can work out with this, that they can build a general template, almost a template for prospectuses or the ways that private equity firms can advertise. Now, I know that the new solicitation ban being lifted movement is relatively limited in terms of how much that PE firms or private investment firms in that matter can really solicit or advertise. So I think what's going to be the bigger thing is once we understand to a fuller extent what PE firms can really show and what they can't show. And the biggest way to do that is to see any sort of private equity firm that's really that's really capitalized on that opportunity. I think it'd be more helpful for the smaller firms if it really comes to that matter. Because when you look at it in history, the lower middle market and the middle market private equity firms have tended to be more conservative, tended to be more cautious, and tend to be more operations focused on their investment portfolios, onto their investment criteria, and just in general, their investment history. So I think because of their connections to the family offices, their connections to pensions and regional banks within their communities, I think it's going to be a bigger boon for them because they have a greater opportunity to build an image as well as even get a little bit more funding throughout their investment portfolios.
All right, and I want to take a little bit of time now to talk about your new role. Obviously, so many of us in the private equity journalism universe have kind of counted on your filings updates and deal updates, and I probably would have been getting my daily Dell deal update from you today. Did I not get it from another media company? What's going on with you at GIST, and what's going to be kind of the role in the company within the PE, within the PE world?
So GIST Digital is a mobile and app development studio. What we do is that we build mobile and app strategies for large companies. We're also building it for a lot of consumer and retail focused companies to start with, but we're looking to expand across all real areas of sectors, whether it's on the manufacturing or the industrial or the energy side. We're also going to be building an incubator, a lot of mobile and app focused companies for individuals and for small groups that would serve either some small sort of purpose or to a larger extent. We have a great team of developers, and we've really, the biggest reason why I joined the company is that it's full of veterans. We're looking at 10, 12, 14-year veterans across the design, the development, and the network space. I mean, you're looking at 12-year veterans from Cisco Systems. You're looking at designers from the guys who did the stuff for Time Out New York and the Food Network. I mean, our lead developer was the guy who put AOL Instant Messenger into the App Store. He actually is the reason why everything at Gannett, him and his team, I should say, that USA Today and all of different newspaper apps under Gannett have changed on their mobile and app strategy. So the reason why I joined it is not so much that I'm going to be going to the startup world and helping to build up an area that is only just getting started, as the CEO of BetaWorks actually mentioned a couple days ago at an event called Pando Monthly. It's really that I'm joining that team of veterans. Now, what I'm going to be doing is I'm going to be doing business development and partnerships work, meaning that there are brand strategy firms, there are advertising agencies, and there are even private equity firms with companies that need a more mobile or an app-focused development. you can definitely see that private equity is taking the branding situation a lot more seriously, because the biggest example is when you see AEA Investors, a very large private equity firm that never has really gotten to this space, put almost $70 million into one of the big brand strategy firms called Brand Strategies, or Brand Network, sorry. It's something that you can see within an industry that is truly understanding it. And as you move forward, we're building mobile and app-focused designs, and a lot of the companies in the consumer and the retail space, or even the food and beverage space, if you just look at that independently, they have great opportunities to grow. I mean, you know that private equity firms have companies like Hooters. You have private equity firms that have companies like Rosa Mexicano, where they've got pretty straightforward competitors. So if you can build something on the mobile and the app space that will reach out to consumers, that will really have an opportunity for them to differentiate, to grow that customer base, the sky is really the limit. And that's why I ended up joining Gist and taking my private equity connections over to there as well. It's gonna be a wild ride, because I mean, this is the first time in the startup world, and it's gonna be a lot of fun. I'm looking forward to it.
All right, well, we'll definitely be on the lookout for the products coming out of Gist in the future. I'm John Marino, and that's the deal.